Hi all, welcome back to our YouTube channel. Topic that we will have a look at today is from FRM Level 1. It's from Paper 3, Financial Markets and Products. And the topic is, it's from chapter Properties of Options, and topic is bounds of the options. So we will have a look in detail about upper bound and lower bounds of the European and American call and put options. Yeah, before we go ahead, please do subscribe to our channel. It takes a lot of efforts to come up with quality videos like this. And please do share with your peers also who are preparing for FRM exams or in general any if they are aspiring to have their career in risk management. So before we touch upon bounds, so it's very crucial that we have very sound understanding of the options. So I will start with very basic definitions of call and put, but I would request that stay till the end of the video. Sometimes we presume that we know a lot of things, but when we try to reproduce things, it's like we really encounter the challenges. So stay till the end of the video. There would be lot of learnings in between video, and it will make your journey very smooth for your learning objectives of option strategies and other stuff that pertains to options in whole FRM curriculum. So stay till the end of the video. Let's have a look. So very basic definition. As I said, it may appear that you already know, but just stay till the end of the video. You will know various dimensions of the same definition in front of you. So call option is a contract that gives the option buyer the right, but not the obligation to buy an underlying asset at a specified price within a specific time period. So it's a right, not the obligation to buy certain underlying at a predetermined price. Similarly, if I talk about a put option, it's the right to buy, it's a right to sell underlying asset at a predetermined price, and you enjoy that right for certain period of time. And like just a point to note over here is the specified price is known as a strike price, and usually the notation used for this strike price is either capital X or it's capital K. So if I were to summarize that, so from the above definitions are from the long parties. So if I say long call or a call buyer, it has a right to buy, and the payoff formula, when I say payoff, it's a formula that you need to calculate the intrinsic value of the call option. So like if I were to explain you a bit more, you pay X, that's why it is in negative, and it is presumed that you buy at a cheaper in the call option contract and you sell in the market at a higher price, that is a spot price that is prevailing in the market at that point in time. So that's why this S is in plus, and given you pay strike in the call option contract, that's why it's in the minus. So it has a right to buy. But when it comes to very important point to notice, when it comes to the short party, or it is also called as a call writer or the option writer, or you can the terminologies used are different. We call it as a short call seller or a call writer, and the writer or a seller has an obligation. So very important. Usually we tend to think that in option there is no obligation, but short party in the option contract has a obligation. So when I talk about call option seller, it has obligation to sell, because when your long party comes to you that, hey, I want to exercise my option contract and I want to buy at a strike price that we agreed during the call option contract. So call option seller specifically has a obligation to meet that agreement that he did during the selling when he sold the call option. So that's why whatever would be a gain of the long party, that would be a loss for a call option writer. Likewise, when we talk about long put or a put buyer, he has a right to sell. So, and it is usually when you think that underlying is going to go, I mean, it's you are bearish. Basically, you have a bearish overview on the underlying. So when you sell at X, you get X amount, and it's assumed that to sell something, you need to have that asset in your position, and you buy that from the market. That's why it's in negative. You buy that at a prevailing price in the market, so it's negative S, and you sell in the option contract. That's why it's a positive X, capital X. And with the same argument, this gain for a put buyer would be a loss for a put writer or a put seller. So that's why just negative of this is a loss to the short put party. And very important to note, everywhere you see the maximum function with a zero. So your your loss can maximum be zero. So eventually, uh, when it comes to a long party, your loss can be maximum zero. But short party has a different dimensions about the loss. We will look has we will have a look at in the following slides. So let's demonstrate call option. As I said, that we will explore what the options are actually. So let's demonstrate this call option, wherein party has bought a call option with strike $90. That means you have right to buy at $90, and the current spot price when this option was bought was $80. So usually, if you notice, the options are bought out of the money. Options are bought. So whenever the price exceeds 90, you can exercise your call to buy at $90, and likewise you can sell in the market at a higher price. So let's have a look at that. So I'm just emphasizing the first row of this table that we saw in the previous slide. It's right to buy at X, and the payoff formula for this is maximum of 0, comma spot minus strike. And these are the various ranges that we were being asked. So say for example on maturity or on the next day itself, the spot price. So it was when it was trading at initially when contract was traded, it was at $80. Now next day, say for example, it goes down to 60, and you have right to buy at 90. So no one will like to exercise call option wherein you have right to buy at 90, wherein you can buy in the market at $60. So when spot price is $60, that is when your spot price is less than strike price. For a long buy contract, it's not worth to exercise the call option, because you can buy at a cheaper rate from the market than from buying it from the option contract. Likewise, it applies to 70, 80, 90. So, and applying the same formula, max of 0, comma, spot is 60, likewise 70, 80. So it's a negative number and 0, maximum is 0. So till the time it's 90, you will not exercise the call option. But the moment it exceeds strike price, say for example, it goes to 100, then you will exercise a call. Long call party will exercise this call option, and they will exercise the call to, I mean, they will exercise your right to buy at 90, and so they will pay you 90 in the option contract, and they will sell at 100 in the market. So they will eventually generate a profit of 10, and so payoff would be 10, 20, and 30 for these spot prices. And if I were to plot this in the graph, it's like till the time your spot price is below strike price in the long call, you don't have any gain in exercising option contract. That's why it is worthless if your spot price is less than strike price in the long call. But moment it crosses 90, you can have the gains, which can be unlimited if because spot price can rise till infinity, theoretically, of course. And similarly, long put, wherein you have right to sell at 90, and say for example, current spot prices is at $100, and you are waiting that once your spot price goes below $90, say it goes to 80, then you can enjoy your right to sell at $90. So in this case, the position of option contract is long put, and the strike is $90. Current spot is 100, and expiry, say for sake of understanding, it's 1 year. And I'm focusing on the third row of this table that we saw in the first slide. And like payoff is max of 0 comma x minus s, because you sell at x, so you gain x amount. And of course, to sell at x, you need to have that asset in the position. So you buy it from market at spot price. So that's why it's negative of s. And for a put option, uh, if you can sell, uh, if you can sell at something, say at 90 in the market or 100 in the market, you would not like to sell your asset at 90 in the option contract. So when your asset price is greater than your strike price in the long put, say 100, so one would like to exercise this in the market instead of exercising in the option contract. But moment your market falls below 90, say it goes to 80, so you will go to your option seller party and you will say that I would like to exercise my right to sell at 90, and that party has to fulfill the agreement. So you sell at 90 by buying it from the market at 80. So eventually you get profit of 10, 20, and 30 as and when your stock price falls. So for a long put party, till the time your stock price is above strike price, then you don't get any gain in the option contract. But when it falls below your strike price, then you have right to sell at this price. So eventually you end up gaining uh, the linear gain as and when your stock price falls. Now, interesting ones, a short call party, whatever we just saw in the long call, that would be a loss to this short call party. So same option I have taken of the strike $90, and your spot is say at 100, and you are uh, thinking that your spot price will go up. And like what, as I said, that whatever was a gain for this long party would be a loss for this short party. And the same table that we saw for a long put, only the difference would be this would be a loss for a short party. So till the time your strike is your spot is below your strike, the party will not come to you and would ask you that I want to buy at this strike price 90. But moment it reaches 100, they will reach out to you and they will say that I want to buy at a 90, and they would buy it at 90 from you and sell in the market at 100. But eventually for a short call, it's a loss that we saw, which whatever was a gain for a long call that we saw in the last to last slide. So eventually it would be a loss once your spot price exceed your strike price. So it would be like a unlimited loss if you're in a short call position. So very crucial point to note here is that it's not correct to say that the maximum loss in the options is zero, because short call has a obligation. It's not a right. Right is just for a long party. Likewise, put seller argument can be given. So for a put seller, you have obligation to buy because your long put party will reach out to you and they will say that I would like to exercise my right to sell at this price. So please do buy at this price. So uh, same example, but whatever was a gain when our spot falls below your strike, that would be a loss for a short put party, and this would be a payoff that would look like. So it just if I just keep a mirror on the x-axis and try to get a mirror image of long put, it will be a short put. So whatever is a gain for a long put, it would be a loss for a short party. So if I were to aggregate this all graphs, so as I said that if I keep a mirror over here, so whatever is the gain for a long put party would be a loss for a short call party. So whatever, let me correct myself, whatever would be a gain for a long call party would be a loss for a short call party. Likewise, we can give argument for put option also. Whatever is the gain for a long put option would be a loss for a short put option. So this is a summary of last four slides that we saw. Now I think we have got sufficient foundation to explore ourselves to the bounds of the options. So first we will explore call option bounds. So very easy argument can be given for a call option. So initially I'm touching upon the maximum value. So say for example, I tell you that here is a call option which is of $100, which is price of which is $100, and underlying of that I offer you the same underlying at $100. So of course one would like to go for an underlying if I'm offering at the same price, because in when you buy a underlying stock, you get a position of that stock, and when you get a call, it's just a right for some time. So if I'm offering you at the same price, the option and the stock, one would go for a stock only. So the maximum value that call option can take is spot price. No one would like to buy a call option which has a value more than stock price, because it's a rationale of the human behavior that one in that case one would like to buy a stock instead of a call option. And so that's the maximum value of the call option. And if we talk about most important, if we talk about the minimum value, so way to look at it is so your option value is sum of your intrinsic value plus time value. So we saw that the call payoff formula was maximum of 0 comma stock minus spot minus your strike price. But if you don't consider the time value, because eventually you are trying to estimate what can be the minimum value. See, eventually option can have the minimum value of a 0, but we are trying to understand a lower bound, not really a minimum value. So lower bound, what is the minimum price that one would like to pay for a call option would be spot minus present value of the x. Because if I just consider that if it is just x, then you are not including the time value, but time value has to be included in the option price, because you are giving a right to someone for certain period. So you will not give that for a free. If you don't include the present PV of strike, then you are it's like the option buyer can buy a strike. I mean, he can borrow a strike price amount of the strike price at a for a free at a no cost. which is not a case because you can't borrow a money for a free. You have to pay some interest. That's why it's borrowed at some cost. That's why time value has to be included instead of just S minus X. It is slightly higher than that price. So time value, to factor that time value, it has to be PV of X. If you don't include PV of X, that means you are assuming that one can borrow amount at no cost, which is not a true. Hence, we will end up getting a contradiction. So it has to be minimum has to be spot less present value of the strike. That's for the call. So minimum value is your maximum value is stock because no one would pay you more than stock price. Option is just so in that case one would like to go for a stock price, and the minimum value is spot minus present value of the strike. So this is about a call option. Call option is relatively easier because it behaves in same for European and American call. Let's look at put option. So for a put option, so way to look at it for a European put is it's a present value of the strike because if you sell something at 100 today and something at 100 after 1 year. So if you get your money earlier, it's better for you. And you can invest that for certain period of time. When we talk, see you in European put, it just you can just exercise at a maturity. So the maximum value it can have it today is just a present value of the X. Because as I said that you have to factor in time value also. But for American put, there is you can exercise at any point in time, and once you sell at a strike price, I mean in a put option you are in a long put you have right to sell. So once you sell at X, now that entire amount is yours. So whereas in European put, it's that amount is something which you can just encash at a maturity. So it has to be the maximum value is present value of X. So it's slightly lesser for a European put. And for minimum value, the same argument. So option is like intrinsic value for time value. So for when you talk about European put, as I said, something you sell at 100 at a year later and something you sell at today is has a different value. And the minimum value one would ask to the buyer would be a time adjusted value. So that's why it has to be PV of X, because if you it's like once you get that money, you on it's for European put, it's at a maturity only that you can get that amount. It's not today. So that's it's PV of X less spot. And that's not a case in American put. American put, you can just short sell it today. There is no further time value till expiration. Once you exercise it, that's it. You get your money and that. Whereas in European put, that money can be only obtained at a maturity. So that's the difference between American put and European put when it comes to max lower bound and upper bound. So just remember this graph. This is for European put option, wherein the maximum value can be present value of the strike, and the minimum value can be present value of strike less spot price. Likewise, maximum value for American put is strike, which is K or X, either ways, and the minimum value can be strike less spot. One argument for maximum value could be, see if you just notice this payoff formula, the maximum value of this would be when your spot is 0. So when this price keeps going down, your spot will reach out to 0, and your maximum value that your put option can have is your strike price. But for European put, it can be only exercised at a maturity. That's why it's PV of X. So this is what we have for upper bound and lower bound for European and American call and put option. Hope you like the video. And yes, at our institute, it's not just the subject that we teach, but it's just we can try making you think, which is eventually key for tackling exams like FRM or CFA or any other competitive exam. So yes, please do subscribe to our channel. It takes a lot of efforts to come up with videos like this, and please do share with your peers also who are preparing for the exams. Thank you. Stay connected.